Welcome to this step-by-step guide to Fidelity margin rates. Understanding margin rates is crucial for investors who want to borrow money from their brokerage firm to purchase securities. First, let's start with the basics. A margin account allows you to borrow money from your brokerage firm to buy securities, using the securities in your account as collateral. The interest rate charged on the borrowed money is called the margin rate. To determine the margin rate, Fidelity uses a tiered system based on the amount of money borrowed. The more you borrow, the lower your margin rate will be. For example, if you borrow less than $25,000, your margin rate will be higher than if you borrow more than $25,000. Here's how to calculate your margin rate. First, determine the debit balance in your margin account, which is the amount of money you have borrowed. Then, look at the tiered rate chart on Fidelity's website to find the corresponding margin rate. For instance, let's say you have a debit balance of $10,000. According to Fidelity's rate chart, the margin rate for this tier is 8.825%. This means you will be charged 8.825% interest on the $10,000 you borrowed. It's essential to keep in mind that margin rates are subject to change and may fluctuate based on market conditions. To minimize the interest you pay, consider keeping your debit balance as low as possible and making regular payments to reduce the amount of money you have borrowed. In conclusion, understanding Fidelity margin rates is vital for investors who want to borrow money to purchase securities. By following these steps and considering the tiered system, you can make informed decisions about your investments and minimize the interest you pay on your margin account. Remember to always review the current margin rates on Fidelity's website and adjust your strategy accordingly.